The coming earnings quarter in the US will be crucial in supporting the recent stock market rally. From the depths of the coronavirus lows to the highs, the Dow is up by around 50%, and the tech-heavy Nasdaq up over 60% to record highs. Will it be a bloodbath quarter, or will the broad sweep turn out to be a pleasant surprise? Welcome to IG's Trading the Markets podcast. I'm Jeremy Naylor. Joining me today is Chris Bailey, founder of Financial Orbit, a consultancy which provides bespoke financial research. Chris, it's good to talk to you. Thanks indeed for coming on to the pod today. I just want to start, first of all, if I can, about your thoughts on the broad sweep of things. I guess how we feel about the second quarter earnings season after it ends will depend on how good the analysts are in forecasting the numbers ahead of time. As far as you're concerned, should we be set up for a fall, or will the numbers support this astounding equity market rally that we've seen?
Well, this is going to be the absolute nadir of the global earnings season, be it in the States or be it, I would guess, in most other geographies as well outside of China. In the States, you're likely to see a 40% fall in sort of large cap earnings year on year. Absolutely sort of stunning levels of decline. Clearly, it's centered on the fact that companies will be reporting primarily for the April, May, June quarter. And as a consequence, with the US locked down for large swathes of that period, it massively impacts their earnings. But obviously, stock markets look forward. And whilst the numbers will be grim in absolute terms, I think a lot of focus will be on how companies see life looking forward, what they're thinking about in terms of lockdown liberalization, how it's impacting their business, and how they've done in these difficult times. So yes, horrible numbers, but fortunately, the market's a discounting mechanism. It looks forward, and as you've already noted, it's done that quite aggressively already.
So you're suggesting then perhaps maybe that the companies that suspended guidance in the first quarter perhaps may be looking forward in terms of their guidance. What about dividends? Do you expect them to be reinstated for the companies that decided not to pay last time around?
It's likely to be too early, because I think what you'll find is dividends tend to be a sort of a lagging mechanism, and that makes some sense in the sense that companies have to pay dividends out of cash flow. And if they're reporting on a period where companies, their operations have been locked down, your ability so far to have a lot of clarity over the outlook is going to be quite low. So I think they'll be cautious on the dividend side. I think it'll be much more focus on whether they actually give a full year guidance for full year 2020 or not. I think that will be a lot more sort of insightful for the market. And then maybe in the third quarter, or certainly in the final quarter of the year, we'll see a lot more commentary on dividends. Clearly, you've also got areas such as financials, where actually there is a top-down, a regulatory limit on paying dividends. We've already seen that. They're suspended at the moment. They can't do share buybacks. They can't do dividends because the Federal Reserve Bank wants to ensure that they are super prudent and giving away their stress tests with complete clarity. So certain areas have been, if you like, locked down on dividends. I think other areas will be a bit more cautious. So income investors, if you're looking for short-term income, you're going to have to pick and choose very carefully. And inevitably, that's going to push you more towards areas such as consumer staples and healthcare, with that much more natural defensive sort of bias.
Well, let's take a look then in some more detail about the degree that you think there will be a divergence between the sectors. You've highlighted the differences there and some of the outlooks in terms of dividends. But what about the sectors to watch out for, and how divergent are the sectors going to be within the broad sweep of the second quarter earnings season?
Yeah, it's going to be absolutely huge. The minus 40% earnings decline for an index such as the S&P 500 doesn't really capture the sector shifts. So on one side, you've got areas such as utilities or the technology sector, where we're likely to see less than 10% earnings declines on average year on year. And obviously some companies will have earnings advances. Next up would be areas such as the consumer staples and the healthcare side, already mentioned as being defensive. There you're likely to see sub 20% earnings declines, and in some cases clear earnings advances. At the other end of the spectrum, clearly things like energy is going to be absolutely materially hurt. You've got the lagged impact of the very low oil price and all the other shenanigans around that, negative oil transitorily and everything. So that earnings there are going to be horribly negative, could well across the board slip into over losses. so over 100% declines. And similarly, areas that are more cyclical, more naturally sort of operationally geared, areas such as industrials, are also going to be near the bottom of the charts in terms of the sector breakdown. So my perspective would be this is known, this is expected. So therefore the nuance, the value add is going to be picking through and saying, okay, who's going to be doing a bit better or a bit worse than expected, given that kind of broad sector setup. And that's a perfect environment, I would say, for the slightly more active investor. Certainly a good environment for the more value-added management teams as well to make sure their companies are suitably focused. But it's certainly not going to be boring. And there's going to be not just a clear sort of sector hierarchy, but within that, there's going to be a lot of noise and interest as to how specific names are going to be doing.
In terms of sectors, I think banks are the main sector that starts it all off. Clearly, it's in the interest of the government and the central bank to ensure that banks are well protected. But this sector was the big disappointment in the first quarter. More of the same in the second quarter? What do you think are being the major headlines we'll see from the banking sector?
I think really there's three or four. Now that we've had clarity that they won't be able to pay dividends or do share buybacks for the short term until stress tests are signed off, now that we've gone back the other side of that, the focus is going to be, number one, on what is the level of bad debts or troublesome loans that they're seeing. Clearly, whenever you have a problematic period in the economy and you look at the economic backdrop, there's a reason why there's a minus 40% earnings decline. Banks are very geared into that and typically would underperform, would struggle with very bad loans in periods of great economic stress. Clearly, there's been some efforts by governments to try to alleviate that, special lending schemes and related, but an update on the bad debt line will be very important. Next up is going to be how are the banks dealing with the still very flat yield curve? Clearly, we've seen bond yield compression across the board, particularly obviously in the sovereign and higher grade investment corporate bond space. And how the banks are dealing with that environment, clearly unhelpful for the average financial institution. They struggle to make money on any product in that world. So I think an update on that will be insightful. Third aspect will be technology. This is more from the upside perspective. How is the average American bank, financial institution, broker, investment bank and related, how are they dealing not just with the backdrop of a pandemic, but also what that means in terms of a shifting corporate backdrop, how their people are working. Is it effective or efficient to do a lot of working from home? Is there an opportunity here to actually evolve their cost base, but still provide all the services that they do? And that could be right from a retail bank right the way up to the biggest investment bank. So I think there's lots of mega and interesting themes in the financial space above and beyond sort of trying to put together their latest stress tests to make the Federal Reserve happy.
Yeah, of course, that application of technology across all sectors is interesting, isn't it? It's the way that companies use technology in order to bring down their costs. In the context of technology in terms of companies, let's take a look at what's been happening on the NASDAQ. Record highs that we've seen. I said at the top, we've seen a 60% rise from the bottom, the COVID crisis bottom that we had this year, to where we are on the NASDAQ. To some degree, I know, Chris, it tells us everything about where the money's going at the moment, I guess. How do you feel about tech? Has the rally in shares like Tesla, Amazon, Apple, Facebook gone too far, do you think? Or do you think this is only just the beginning of what we're now seeing as the new era in terms of opportunities for investors?
Yeah, it's certainly a regime shift. There's no doubt about that. Working from home, the application of new technologies, we've had, as the old expression goes, in 5 months, we've had 5 years of shift and change. So that's all very positive and attractive. However, I'm old enough to remember back in the TMT.com days of 99 to 2001 and the excitements there. And whilst it seems to me back then there was lots of talk about the rise of the internet, but clearly, as always with markets, people got ahead of themselves. And ultimately, the theme was good. Clearly, the internet is as omnipresent as people hoped 20 odd years ago. And similarly, some of the themes being talked about, working from home, e-commerce, the rise of the information economy, and many more, will prove up even perhaps beyond what some of the big dreamers are thinking. However, markets always have to come back to fundamentals at some point. And certainly an earnings season is an opportunity to say, okay, where are we now? Not so much in terms of are you making gazillions of profits, because clearly many of these companies are not and are not expected to do so, but rather more what's the feeling in terms of cash flow generation or consumption? What is the perception in terms of competition levels and adoption by people? What are people willing to pay for a technology? I think this will all be very interesting and exciting to see. So I'm very, very positive about technology per se and innovation and change. I think that's a wonderful theme for any investor. I am frightened, scared by some of the valuations out there, and consequently, I think it's very much a stock picking driven approach. And as we've seen, when you do get a breakdown in periods of extreme excitement, shares can come down, as the old saying goes, in a lift very, very quickly. You can see some very, very sharp falls in a very short period of time. So certainly on some of the more excitable areas, I would be cautious going into this earnings season just because of the sheer euphoria and excitement that we've seen in markets over recent weeks and months.
Yeah, you mentioned working from home, and of course we've been in lockdown, and many of us, and indeed in the States, of course, this perhaps maybe more so than in Europe, and certainly in some areas of the Far East, where the US is in a precarious situation. We don't yet know whether or not there's a second wave or it's a continuation of the first wave, and how serious it's all going to get. But one of the things we do know is that, as you say, people aren't getting out and around, and public transport is finding the going tough. Airlines are finding the going tough. I know you've got your eyes on the likes of Boeing as well, which supplies the airline sector. But on the other hand, some people are saying, is this the opportunity to buy into a beaten up sector? How should we be viewing airlines coming into this earnings season? And do you think there will be opportunities out there for investors to pick up bargains that we'll never see again?
The answer undoubtedly is yes. I do think it's going to be much more of a stock selection market than perhaps people generally think over the next year. And I say that because we've had such a concentrated, narrow market in more recent months. I think it naturally has to broaden out. And I think that's correlated with economic recovery and hence hope for the future. And certainly, I think we're seeing the starts of it in other geographies. And you're absolutely right. The States has to get materially beyond the pandemic first or second wave. I think it's still probably technically the first wave in order to do that. But I kind of believe they will. And so, yes, I am well disposed towards value sectors. I think what this earnings season will inform us, though, is which companies truly have batten down the hatches in these more cyclical or troubled sectors and have sustainability and resilience. And so it's going to be really, forget the losses per se, think about the balance sheets. And that particularly applies to, let's say, a Boeing or an airline sector or your average nuts and bolts industrial type company, where clearly trading conditions have not been easy. So I think it's all about the balance sheet. It's all about resilience, because let's face it, they're doing things which are important for the US economy and the global economy going forward. They're required. And so there is some sense that the strongest will survive, and not only survive, but actually thrive, because they'll ultimately take more market share. But in order to do that, they've got to get through this tricky period. And let's not forget, the most difficult period for a company is not actually a recession, it's coming out of it, because you need things like working capital and stuff like that. So all about the balance sheet. The trouble is with something like a Boeing is you've got a lot of longer term liabilities. And I think they would be probably wise to tap the capital markets again if required, in order to make sure they're suitably strong there. Exactly the same with areas such as the airlines, which are very, very geared into uses and utilization rates and stuff like that.
Yeah, let's just pick up on the oil sector as well, not too far away aligned from the airline sector. Airlines, of course, love low oil prices, but not being able to capitalize on that at the moment. You mentioned industrial companies as well, another area where there's a fairly high demand for oil. Oil is very low at the moment for obvious reasons. There's this demand shock that we've had, and that people just aren't using the oil that they used to. And oil has indeed in the last, 10 or 12 weeks or so, of course, we've been negative, one of the futures contracts. What about the oil companies? I guess longer term, the worry is that they're not going to invest in new fields and new opportunities. But what about the short term for oil companies? More downside to come?
I think oil is a very deep value sector. in the sense that it actually has the low of all the sectors. It is the one most disliked by the average institutional investor, which immediately makes it interesting, of course, because if everybody hates it, maybe there's something there. Certainly you haven't had any positive flow of funds into the area. So I think there is deep value. What you need to see is further stabilization of the commodity price. That always helps. But also because it's a sort of an area which is cyclical or interlinked with industrial demand and other final use areas, what you're going to need to see is an economy which is overtly starting to bounce back. And obviously that's still a work in progress. But my impression is we're at the absolute bottom of the perception towards the oil space. Longer term, absolutely, you've got the whole green initiatives, environmental concerns, and everything else. And that puts a certain structural cloud on the sector. But my feeling is when I look at the large cap oil stocks, either side of the Atlantic, but let's focus on the States. Let's think about the Exxons and the Chevrons and people like that. My perspective would be there is a higher price to come over the balance of the year. And consequently, I think it's quite interesting. So expect a lot of red ink. You've already seen asset write-downs in the more UK listed ones. Expect a bit of that to seep into some of the US names as well. But they've got big balance sheets. They're not excessively leveraged or anything like that. They also have been very committed to their dividend levels. I think that might come under pressure. We've obviously seen elements of that within the London market already. I think that will probably come, but my feeling is that is factored in. I think this is a deep value area to be focusing on and be interested in, because undoubtedly no institutional investor is running towards it aggressively at the moment. And that to me is a great opportunity.
Yeah, they've not been running towards oil, but my goodness, they've been running towards pharmaceuticals. It's been a really interesting sector, this, Chris, with some small caps, I know, with a product leaning towards COVID, having seen something, in some cases, 1,000% increase in shares on the upside. But this is a sector that usually provides some insulation from a market downturn. I'd like to ask the same question that I did on tech. Has it moved a bit ahead of itself, do you think?
I think actually it comes back to the same answer as tech, which is it undoubtedly is moving into greater differentiation. Certainly, pharmaceuticals, healthcare, it's kind of split into two zones. One is the more kind of steady, boring, big pharma style, and the other is biotechnology. And as you say, there's been some excitable shifts in the biotech space, particularly with some of the companies with exposure to COVID facing products. However, I would say looking forward, the value is a bit more idiosyncratic. You've got to pick and choose a bit more. An area actually I would highlight, which I think is going to be of interest, is going to be the bounce back of the sort of medical technology area. Not so much benefiting from sort of information technology trends, but more the areas looking at the replacement of joints and other related areas like that, areas which have been hurt by the shutdown because they haven't been doing surgeries and related. I think that is a big thematic growth sector, demographically focused, no doubt, benefits from aging populations and longer term trends, which has sort of fallen a bit out of favour in recent months because surgeries have not been undertaken. So I think those companies are going to be names such as Stryker, for example, well worth looking out for. Otherwise, I think the value is probably is going to swing back towards companies with overtly interesting pipelines of products. And a company such as Gilead, for example, which has got a lot of press over recent months because of potential COVID-facing excitements, actually is a name, I think, with a lot deeper interest because there's a lot more going on there behind the scenes in terms of their prospective pipeline. I would also highlight early on in the earnings season, you've got Johnson & Johnson, and that's always a great bellwether to look at. Again, has got some COVID-facing interests, but it's a relatively small part of their business. A much bigger part encompasses more mainstream pharmaceutical products, consumer healthcare and related. Very good bellwether indicator of broader healthcare trends. And I think a bit like technology, it is going to be the broader, more perhaps more idiosyncratic trend, which is going to be more interesting to people rather than this sort of grandiose, oh my goodness, this is a direct beneficiary of what we've seen in the last 3 months. I think that's what I expect to see much more in this space.
Yeah, moving on from healthcare products, not too far away actually, the FMCG, fast-moving consumer goods sector, those that have given us the essential supplies in some part during the lockdown. I'm talking here about Procter and Gamble, Colgate, Kraft Heinz as well, the food companies, Coca-Cola. What are your thoughts here? I mean, for me, the potential upside surprise could be in this area here to see how well they've coped during this lockdown, where they've obviously been under some sort of constraints in terms of their ability to be able to deliver and distribute. But at the same time, we as a consumer have been wanting precisely what it is they're marketing.
Yeah, absolutely. They've been big beneficiaries. You've seen significant volume increases in what the Americans call the sort of the pantry loading effect. One wonderful phrase for names, as you've mentioned, names such as Procter and Gamble and Colgate and Kraft Heinz. I think going forward, what I'll be focused on is not so much the fact that there was some pulling forward of sales. I think that is generally understood. And I think you'll see for example, in June and maybe for their guidance for the next quarter, lower levels of volume advances. What I'm interested in is their perception towards pricing power. Because undoubtedly, what the big theme above and beyond a sort of a pandemic-induced pantry loading period, the big theme is a more cautious consumer, a consumer which is dealing with higher unemployment and other sort of consequences of a period of economic overt recession, is generally a bit more choosy about the products they buy. And so pricing power and brand strength becomes super important. And I always think when I look at things like price mix, when I look at the detail of companies' results, it's a super important metric. And certainly it's been an impressive one for names such as Procter and Gamble and Colgate in quarters gone past. And certainly for companies such as Kraft Heinz, for them to really crack on and to try to sort of repay the faith that a Warren Buffett has invested into them, they're going to need to see pricing power, because otherwise I kind of feel as if you're on an ultimate vicious circle once that pandemic sort of pantry loading period kind of finishes.
I just want to quickly touch on one other sector. The US is not known for its mining companies. You want the big mining money, of course, you have to go to London. But there are some miners in the States with gold at levels not seen in, 8.5 years now, I think, at over $1,800 an ounce, and copper at a 5-month high. Anything you want to talk about in terms of mining stocks to watch, or is this an area that's really not of much interest in terms of what we're likely to see?
I think it's a great interest for all the reasons that you've mentioned, Jeremy. And for me, what I really love about the US names is that it's really actually the US Canadian names that are of that sort of North American earnings season sort of hat on here. And so you have to look at Barrick Gold with their strong management team now. When they took over Randgold, which was listed on the London market a couple of years back, or even the resurgent Newmont. I think you're seeing the strength and this sustainability of their gold producing operations actually is a real positive. So clearly massively geared towards the level of the gold price. There's only so much they can do to offset that. And as you say, firm gold prices and continued interest in the sector should mean that those names will get a lot of focus. And it seems to me they're throwing off a bundle of cash at the moment, which is a very great position to be in. Elsewhere, I'm saying copper. I think a name to watch undoubtedly is going to be Freeport McMoran, which has got some gold exposure, but it is best known for copper. It's got a lot of problems. Clearly, mining is a very global business, and whilst a Barrick Gold or a Newmont, a lot of their value is in some of their Nevada or North American mines, among other places. Freeport's got a big mine in Indonesia, which has had a number of problems and issues and challenges, but they seem to be coming out the other side. There's been a little bit of chat in the press and whatever about a Barrick Gold Freeport combination, which would be a very interesting one, mainly because if that is the case, that is Barrick Gold actually saying there is better value in copper and a bit more gold than in their sort of a continuation of their own operations or just returning it back to shareholders. So watch out for comments on that particularly. I'm not expecting a deal. I've not got a crystal ball or anything. I think there's been so much in the press that is going to be one of the first questions analysts ask about the management teams when they push out their results in the next few weeks. So to me, as always, when you ask a mining executive whether you want to buy or build or return cash to shareholders, you're going to get an interesting answer. So that's something to watch.
Okay, Chris, look, we'll have to leave it there, but thanks indeed for joining us. It's been a pleasure talking to you about the second quarter earnings season. Looking forward to that with a lot of anticipation. But Chris Bailey, in the meantime, thanks for joining us on today's IG Trading the Markets podcast. Chris is the founder of research house Financial Orbit. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.